In this tutorial, we'll be covering the price earnings valuation model. The price earnings valuation model, or PE model for short, is what's known as a relative valuation model. Now you might be asking yourself what the term relative means. And simply put, it's a valuation model that uses the values or the prices of other companies in order to work out the value of the company of interest. Let's provide clarity on what this means by using an example. Let's say you've got a company called Company A, you've got another company in the same industry called Company B, and you've got another company again in the same industry called Company C. So for Company A and for Company B, you've got the earnings per share and you've got the share price. The earnings per share for Company A is 10 Rand, and for Company B, it's 15 Rand. The share price currently of Company A is 50 Rand, and the share price for Company B is 105 Rand. So we see that for 10 Rands worth of Company A's earnings, investors are willing to pay 50 Rand. So that's a price earnings multiple of 5. For 15 Rand worth of earnings in Company B, investors are willing to pay 105 Rand. And the 105 Rand divided by 15 means that the price earnings multiple for Company B is 7. To put it differently, for Company A, shareholders for a Rand's worth of earnings are willing to pay 5 times that amount versus a multiple of 7 for a Rand's worth of earnings in Company B. So if we had to work out the average price ratio for the industry based on these two companies, we could work it out as follows. So it's the price ratio or the price earnings ratio of A, which is 5, plus the price earnings ratio of B, which is 7, divided by 2 gives you 12, divided by 2 gives you an average price earnings ratio or multiple of 6. So we can use this industry average price earnings ratio to come up with a share valuation for any other company in this industry. So let's say Company C has earnings per share of 20 Rand. Now, given that other shares or the average share in this industry is trading at a multiple of 6 to its earnings, we can work out the share price for Company C as follows. It will be the 20 Rand earnings per share multiplied by 6, and therefore Company C should have a share price of 120 Rand if the pricing of companies in this industry remains constant. Now, this doesn't necessarily mean that this is the price that's currently observed for Company C. This merely tells you what the price should be if the pricing mechanism remains the same. But Company C could be trading at a higher multiple than the industry average. Perhaps it's trading at a higher multiple of 10, giving it a share price of 200. This could mean one of two things. Either the stock is overvalued, so it's far too expensive, given that all other assets or the industry average is 6, so this stock is expensive, it's overvalued compared to its peers. Or alternatively, it could be that this asset has got great prospects. So people are not just looking at the earnings of 20 Rand currently, they're factoring into the price of 200 the future earnings of this company, Company C. On the flip side, Company C could be trading at a low multiple in relation to its earnings, let's say 2, which would give it a share price of 40 Rand per share, and this would mean that Company C is undervalued compared to its peers, because its peers are trading at a multiple, the industry average is 6, and it's only trading at a multiple of 2. So this might present a buying opportunity in company C.